In this market update, I'm going to be talking about the overconcentration of the U.S. market in just a few stocks. Hi, Jim Gore from THOR Wealth Management. Well, just as a reminder, in our prior videos, we've talked about small companies being more attractive here in the United States than large companies. And this is part of the charts that we have created here at THOR to show that where we are right now, the time period of small company underperforming large company is one of the longest, but also it's been one of the steepest. You have to go back almost to 1930 to find it as steep as it is right now. So small companies are certainly more attractive than large companies, but keep in mind, THOR is a very dynamic investor. We are certainly more invested in U.S. small company and large company, but both of those segments are still underweight what most investment advisors have in the United States. And the reason for that, as we mentioned before, is you look at this chart here, and this is looking at emerging markets versus the U.S., and you can see one thing I want to point out is you look at back in 2009, 2010, when we were talking to most representatives when they come into our office, they were telling us most RIAs, registered investment advisors, back in 2009, 2010, had 40 to 50% of their money internationally, with half of that in emerging markets. THOR had nothing in emerging markets and our lowest exposure to international ever at that point, and you could see that they were overvalued. They've collapsed, and right now, we are more than 2 standard deviations off the norm for emerging markets versus the US. So emerging markets are certainly more attractive, and I'm going to talk about why it's important to have active management in this space at the end of this video. Now let's look at the US. The US stock market has been really concentrated. We all know the Mag 7, but this is just looking at the top 5 stocks in the S&P 500. And you look at the weighting right now, it's 28% of the index. This is higher than any time in history. And you go back to 1999, before that crash, we were looking at about 18%. So it's more concentrated. And another way to look at it to show that it is more concentrated is let's look at history. And you look at this, you've got to go back to the 1930s to find the U.S. stock market as concentrated in just a few stocks as it is today, which means that everybody's there. The money is already in that space, and when they need to take money out, that's probably a space that they're going to sell because it's going to be the most liquid. And just like we saw in 2009, 2008, 2009, near the end of that collapse, they were selling anything that were liquid, and they were selling actually the larger companies at that juncture. But more importantly here is just an overconcentration, and everyone is talking about index funds and just being indexed to the S&P 500. Index funds are good, and there's a reason why they're good, low cost and so forth. And there's certain areas that we have index funds really in our clients' accounts right now, but not in the U.S. stock market. And we think that this is a time that you're going to see managed portfolios do better than the unmanaged index funds, just as we saw from 2000 to 2010. This is the majority of stocks in the S&P outperformed the S&P 500 itself. And that's because the smaller companies did very well. It was very easy in that time period to generate a 3-4% annual rate of return above the S&P 500. And we're seeing kind of the concentration where it's just a few stocks driving it, just as we saw back in 1998 and 1999. So this is a time that active management is going to be a lot more important to your portfolio. And the reason for that, especially in the small company space, is you look at this chart here. If you're buying an index fund, the Russell 2000, you are buying an index fund that has 47% of the companies are unprofitable. There's a lot of opportunity here to get active management for profitable companies. But also noting this, the last time that it was above, the time period was 2001, we actually saw earnings for small companies go up in that time period while the stocks were going up. Think about what's happening right now. We're going to deglobalization. It's going to be easier for small companies in the United States that are more domestic oriented to outperform and have higher profit margins than those that are global companies that had to deal with a lot of the tariffs. This is also why we like active management in the emerging market space, especially the small company emerging markets. There's more opportunities out there than buying an index fund because no one's looking at that space. Same thing with the small company stocks. You can look at, anyone can get a research report on Meta, but try to get, a research report on a small company like OneSpa World. Very difficult to find that. So there's more opportunities with active management. And we believe this is a time that you want to have active management of your portfolio. If you're just in the S&P 500 index fund right now, you definitely want to diversify away from that in U.S. large company. Go to small company, but you want to have active management. If you have any questions or concerns or need help, give us a call or reach out to us on our website, thorwealthmanagement.com. Look forward to talking to you in a couple weeks. Take care.
Subscribe to the Thor channel today.